I hope you're enjoying the video series thus far. If you are, be sure to like our Facebook page and subscribe to our YouTube channel where we post complimentary mini lessons from time to time. And be sure to follow us on Instagram and LinkedIn. We love hearing from our students, so be sure to keep in touch. So far in the series, we've covered the different types of investments, various aspects of taxation, and even some registered plans such as RRSPs. Now, let me ask you a thought-provoking question. If you were about to retire today and had $1 million accumulated in your RRSP, do you think that's enough? It can be a pretty scary question. On the one hand, you know you're retiring, which means your employment income is going to stop forever. On the other hand, you have no idea how long you're going to live and therefore how long your retirement savings are going to have to last. It could be 10, 20, 30, 40 years or even more. You really don't know. For many, an insurance product known as an annuity could be the answer. If you visit SeeWhy Learning's website, you may be surprised to learn that we support over 20 different exams. One of my colleagues teaches a wealth management series in which he touches upon term annuities, which can be sold by any financial institution, and life annuities, which can only be sold by insurance companies. When I watched these lessons, I thought they were fantastic, and to be frank, I couldn't do a better job myself, so I figured why recreate the wheel. I've included 2 of his mini lessons for you here in this series. I hope you enjoy them as much as I do.
An annuity can be defined as a series of payments. While the definitions sound simple enough, there's quite a lot to learn. But before discussing annuities, consider the following story. Gordon's daughter Rebecca landed her first summer job at the age of 15, and it was a great one. At the end of each month, she'd receive $1,000 net of taxes. When school let out, she immediately started working, and 1 month later, she received her first $1,000 paycheck. Much to Gordon's surprise, only a few days later, she wanted to go to the movies and she asked him to borrow $20. She had spent her entire paycheck. I guess she had some pent-up demand and bought herself a new laptop or phone or whatever, but the bottom line is she ran out of money. Now, being daddy's little girl and all, Gordon helped her get by for the rest of that month, but he also harped about the importance of budgeting and gave her strict instructions. When you get your next paycheck, come and see me. The next month, Rebecca gave Gordon her $1,000 paycheck. Gordon took it and promised to pay her $255 a week for the next 4 weeks. That way, if she ran out of money, the longest she'd have to wait for her next payment is 1 week. Essentially, Gordon gave Rebecca a 4-week term certain annuity. The $1,000 she gave him could be thought of as the annuity premium. The $255 she received each week could be thought of as the annuity's series of payments. Over the life of the annuity, she would receive $1,020 in total payments, which is her principal back plus $20 of interest. Gordon was obviously pretty generous with the interest rate. Now, in the real world, financial institutions don't issue such short-term annuities. Instead, 10, 15, and 20-year terms are more typical. As we discuss the different types of annuities that are available in the marketplace, I want you to keep the following 2 key points in mind, and I'd even jot them down and refer to them regularly as you learn about annuities. Number 1, an annuity can be defined in 4 words, a series of payments. In Rebecca's case, she received a series of 4 weekly payments. And number 2, while there are countless variations, the primary difference between annuity types is how long the annuity will make payments for. This second point is the key difference between the following types of annuities. Number 1, a term annuity, which we've already briefly discussed. Number 2, a straight life annuity. Number 3, a life annuity with guaranteed payout period. And number 4, a joint and last survivor annuity. In this mini lesson, we'll discuss the easiest annuity to understand, which is a term certain annuity. A term certain annuity is exactly what it sounds like. The term is certain. For example, suppose Arnold buys a 10-year term certain annuity with annual payments of $10,000. He knows for certain that the annuity will make those payments for 10 years. No more, no less. Unlike a life annuity, which we'll discuss in other lessons, the number of payments is not impacted by how long Arnold lives. For example, if Arnold lives another 20, 30, 40, 100 years, the annuity will only make payments for 10 years. On the other hand, if Arnold dies after only 1 year, the annuity will continue to make payments for another 9 years to the beneficiary he named. Notice that in both cases, the annuity would make payments for a total of 10 years. When the insurance company establishes the price of a term certain annuity, which is referred to as the premium, the following two things are considered. First, the length of the term. For example, all else being equal, a 10-year term certain annuity will cost more than a 5-year term certain annuity. And second, the current interest rate environment. In other words, the interest rate for the applicable term when the annuity is issued. Now, depending on what courses you've taken in the past or what life or work experience you've gained over the years, you may have heard that annuities are generally issued by insurance companies. So it may surprise you that when pricing a term certain annuity, the annuitant's age, health, and even life expectancy is irrelevant. Well, this makes sense because the payment period is not impacted by how long the annuitant lives. To really drive this point home, consider the following two clients that are both buying a 15-year term certain annuity that will provide annual payments of $20,000. Mabel is 50 years old and is in great shape. Mark is 80 years old, is a heavy smoker and drinker, and has significant health issues. So who do you think would pay the most for a 15-year term certain annuity? Well, you can probably already tell that this is a trick question. Both of them would pay the exact same premium because both annuities will make payments for exactly 15 years. Also, since the client's life expectancy is not a factor, term certain annuities can be offered by many different types of financial institutions, such as banks and trust companies, not just insurance companies. In the next mini lesson, we'll discuss life annuities, which are impacted by how long an annuitant lives, and therefore life expectancy is a critical pricing factor. Lenny is about to retire and he has $1 million accumulated in his RRSP. The $1 million question is, will that be enough? Well, there's a lot to consider. What return will he be able to generate on his investments? What will his expenses be? Does he expect his standard of living to change? How much annual income will he require? And perhaps, most importantly, how long will he live? For example, if Lenny lives another 10 years, he'll almost certainly have enough. If he lives another 20 years, he'll probably have enough. But if he lives another 40 years, sheesh, I don't know, maybe not. Of course, Lenny has no idea how long he's actually going to live, so he's concerned about outliving his resources. One solution that's available to him is something called a straight life annuity. Have you ever dreamed of winning the Cash for Life lottery? What would you do with $1,000 a week? Imagine having the peace of mind knowing that you'll have a certain amount of income on a regular basis for the rest of your life. Well, if you win this type of lottery, what you're essentially winning is a life annuity. Now, the odds of winning the lottery are slim, but the good news is you can purchase a life annuity for yourself. Let's talk about how a life annuity would address Lenny's concerns about outliving his resources. Lenny sat down with his life insurance agent to discuss some of the options for his retirement, one of which is a straight life annuity. The agent ran the numbers and explained the annuity to him as follows. Lenny, you pay $1 million premium to the insurance company. In exchange for the premium, the insurer promises to pay you $50,000 per year for the rest of your life. Now, for the purposes of this lesson, don't worry too much about where the numbers come from. I really just made them up for discussion purposes. However, when establishing the premium and applicable income payments, the insurer would certainly consider things like the interest rates, Lenny's life expectancy based on his age, health, mortality tables, etc., and whether any guarantees are being added to the annuity. We'll discuss some of the possible guarantees in another mini lesson. To gain an even better understanding of a straight life annuity, Lenny asked several questions. His first question was, if I live to be 100 years old, I will receive $50,000 every single year? The answer is yes. It's a life annuity, so he'll receive annual income for the rest of his life. Then he asked, what if I live to be 110 years old? Well, the answer was the same, yes. Lenny liked what he heard. He felt that he could certainly live quite well on $50,000 per year and loved that he could purchase this annuity and never have to worry about money again. But then he asked another question. If I buy the annuity and die after receiving only one $50,000 payment, what would happen then? Well, nothing. The annuity is over and no more payments would be made. With a straight life annuity, you are assured income for the rest of your life. But depending on how long you live, that could be decades or much less. The reality is nobody knows how long they're going to live. What would you do if you were in Lenny's shoes? Well, a big consideration would probably be, are there any dependents? For example, if Lenny is single, has no children, and nobody to whom he wishes to leave an inheritance, a straight life annuity may be perfect for him. However, Lenny is married to Laverne, and she was at the meeting with the insurance agent too. When she heard that payments would stop when Lenny dies, she said, "Let me get this straight. Lenny could potentially give the insurance company $1 million, die 1 year later, and I get nothing after he dies? No way, Lenny, you're not doing that." Since Lenny and Laverne aren't comfortable with the risk associated with a straight life annuity, they could consider adding a guaranteed payout period, which we'll discuss in another mini lesson.